This case begins with a mining firm, M.S. Raja Rajeshwari Minerals Private Limited. The company owned an Ashok Leyland lorry carrying the registration AP29TA8609. They secured a standard commercial insurance policy for the vehicle from Universal Sompo General Insurance, valid from June 2012 through June 2013. In October 2012, 4 months into that coverage window, the lorry was involved in a severe collision that caused extensive physical damage. After the accident, the owners obtained a repair estimate from a specialized bodybuilding garage and submitted it to Universal Sompo for 810,200 rupees. The insurer refused to settle the claim, halting the repair process and initiating a conflict that would last for years. This disagreement over a single repair bill eventually escalated into a national tribunal focused on how much evidence an insurance company actually needs to legally deny a payout. The mining company filed a complaint at the District Forum in Hyderabad, won, and then defended that victory at the State Commission in Telangana. Universal Sompo appealed again, bringing the case before the National Consumer Disputes Redressal Commission, the NCDRC, in April 2026. The total timeline spans 14 years, from the initial policy issuance in 2012 to the final NCDRC judgment in Revision Petition 1459 of 2018. The primary legal boundary for this case is the specific standard of proof required to justify a claim denial. To legally withhold a payment, an insurer cannot rely on suspicion. They must demonstrate a breach of policy terms using clear, documented proof. We can analyze the final verdict by treating the insurer's 4 main arguments as testable claims against the facts verified by the Commission. The outcome shows that an insurer cannot simply cast doubt on a claim. They must meet a strict evidentiary threshold to win. The insurer's first argument focused on the identity of the driver at the time of the crash. Following the accident, the claimant submitted the valid driving license of an employee named Nagaraju, who they stated was operating the vehicle. However, an insurance surveyor suggested that Nagaraju was not actually driving and that the vehicle was being operated by the lorry's cleaner instead. That cleaner, Batula Adinarayana, had tragically died in the collision. To test this theory, the NCDRC looked to the original police documentation of the event. They reviewed FIR number 134, filed by the cleaner's wife, which described his role during the accident. The report stated Adinarayana was working as a cleaner on the lorry when it was struck by another truck, which was being driven recklessly. Universal Sompo provided no witness testimony or forensic evidence to prove the cleaner was the one driving. The NCDRC ruled that a surveyor's suspicion is merely an assumption. Because the insurer failed to provide any concrete evidence, this defense was rejected. The second and third arguments addressed the repair costs and a lack of original bills. The claimant's estimate was 810,200 rupees, but the surveyor provided a drastically lower assessment of 282,999 rupees. The Commission reviewed the reduction and found no basis for it. The surveyor provided no evidentiary foundation for cutting the estimate. Regarding the missing original bills, the court noted that the insurer failed to take any steps to verify the estimates directly with the repair garage. They failed to share the report. They skipped the initial hearings. They failed to contest the evidence. By failing to share findings or contest evidence at the ground level, the insurer lost the ability to argue these points effectively on appeal. The final argument was a technical one, the premature complaint defense. The insurer argued that because they had not yet officially accepted or rejected the claim, the dispute technically hadn't started. The NCDRC found this logic incompatible with consumer protection standards. In legal terms, an indefinite delay in settling a claim is categorized as a failure to provide the service promised in the policy. This delay creates a deficiency in service, which gives the consumer the legal right to sue for their claim. Because the insurer failed to support its defenses with evidence, the District Forum ruled in favor of the mining company. They awarded the full 810,200 rupees, along with 9% annual interest. However, the lower court also added an extra 100,000 rupees specifically for compensation and loss of earnings. The State Commission upheld this entire order, including the additional 100,000 rupee penalty. This left the NCDRC with a specific question. Did this extra compensation align with established legal logic? While these forums protect consumers, they are bound by the precedents set by higher courts regarding how damages are calculated. The NCDRC upheld the core claim, but made an adjustment to the lower court's financial award. To do this, the Commission cited a specific precedent from the Supreme Court of India. The case was DLF Homes Panchkula Private Limited versus DS Standa. The ruling in that case states that awarding multiple compensations for a single deficiency in service is not justifiable. In this instance, the 9% interest on the principal amount already covers the compensation for the delay and loss of earnings. Because the interest already served this purpose, the NCDRC removed the additional 100,000 rupee penalty from the order. The final ledger shows the principal of 810,200 rupees, the interest, and the litigation costs. The NCDRC struck the extra penalty to prevent redundant compensation. The case confirms that insurers cannot use unproven suspicions to deny claims, while also ensuring that claimants cannot receive multiple payouts for the same loss.
Zuber & Company, fire forensic experts and forensic engineers. Seeking answers from ashes. Seeking answers.